Okay, let's dive into this. Welcome to today's Explainer, where we're decoding one of the absolutely most critical, yet honestly completely misunderstood documents in the entire corporate world. We're talking about the auditor's report. We're going to map out what we like to call the spectrum of trust. So here's the million-dollar question for, well, really any investor, employee, or stakeholder out there. How do you actually know if a company's financial statements are telling the truth? I mean, sure, management prepares these statements, but an independent statutory auditor's sign-off, that is the ultimate key to trusting a company's financial health. Because without that independent verification, you're kind of just taking management's word for it, right? The auditor is basically your proxy for the truth. Okay, real quick, here's our roadmap for today. First, we'll be decoding the audit report. Then, we'll look at the ideal scenario, unmodified opinions. Third, the pivot to modified opinions. And then we'll break those down into the qualified opinion, the adverse opinion, and finally, the disclaimer of opinion.
All right, Section 1, decoding the audit reports.
So when an auditor finishes their big, extensive examination of a company's books, they have to formalize their findings, right? They don't just, shoot off a casual email. They issue a highly structured opinion. And statutory auditors broadly divide their opinions into two main categories, the unmodified opinion and the modified opinion. And this brilliantly illustrates how this simple binary is the foundation of our entire spectrum of trust. Literally, every audit report you're ever going to read will fall onto one side of this initial dividing line. Moving on to Section 2, the ideal unmodified opinions. All right, so when you see an unmodified opinion, which, by the way, is also known in the industry as a clean or unqualified report, you're looking at the gold standard. It means the auditor is fully satisfied that the financial statements exhibit a true and fair view of the enterprise. But they don't just hand these out like candy. Some very specific conditions must be met. The financial statements have to be prepared using generally accepted accounting principles and applied consistently. They've got to comply with all relevant statutory regulations. The company must have adequately disclosed all material matters, so no hiding the important stuff. And lastly, if the company changed how they apply accounting principles, those changes actually have to be properly determined and disclosed. So if all those boxes are checked, boom, you get a clean bill of health. Let's move to Section 3 and see how this builds, the pivot to modified opinions. Now, the real narrative intrigue happens when the auditor is not completely satisfied. According to the Standard on Auditing number 705, or SA 705, there are two primary circumstances that force an auditor to step away from that clean report and raise a red flag. First up, the auditor concludes that, based on their evidence, the financial statements as a whole are not free from material misstatements. Basically, they found significant errors. Or, second, the auditor is simply unable to obtain sufficient appropriate audit evidence to even make a conclusion. So either they found something definitely wrong, or they were essentially blindfolded and just couldn't check thoroughly enough. So the crucial point here is understanding the term pervasive. This single word is the absolute hinge for classifying exactly how severe a modified opinion is. In auditing, an issue or misstatement is pervasive if its effects aren't just confined to one specific line item. Or, well, if they are confined, they represent a massive, substantial proportion of the financial statements. It also applies if missing disclosures are totally fundamental to how users understand the financials as a whole. Think of pervasive like an issue that bleeds into the very fabric of the report, kind of infecting the whole thing. Now, what's really interesting about this slide is this decision matrix is basically the ultimate corporate cheat sheet for understanding auditor verdicts. Let's look at the rows. You either have misstated financials or an inability to obtain evidence. Now look at the columns. The issue is either material but not pervasive, or it is both material and pervasive. So if you have an issue that's material but isolated, not pervasive, you get a qualified opinion. But if the statements are misstated and that misstatement is both material and pervasive, meaning it ruins the whole picture, the auditor drops the hammer with an adverse opinion. And if they can't get evidence and that black hole of information is material and pervasive, they issue a disclaimer of opinion. Keep this matrix in the back of your mind as we dig into the specific types. Section 4, the qualified opinion. A qualified opinion essentially translates to the auditor saying, hey, everything here represents a true and fair view, except for this one specific thing. The issues they found are material, meaning they're definitely large enough to matter to an investor, but they are not pervasive. They're contained. When this happens, the auditor is actually required to change the heading in their report to specifically say, basis for qualified opinion. It's a very clear signal telling the reader, hey, pay attention to this specific flaw. Let's ground this theory in reality, right? What does a qualified opinion actually look like in the real world? Well, we have two excellent practical scenarios. Scenario 1, the company didn't adhere to Accounting Standard 2 regarding how they value their inventory. Maybe they valued it slightly wrong, but that error only affects the inventory line item, nothing else. Scenario 2, management physically prevents the auditor from observing the counting of the physical inventory, and that inventory represents a material amount of money. In both of these cases, the auditor is qualifying their trust based on these specific contained issues, but they aren't throwing the whole financial statement in the trash. Moving on to Section 5, the adverse opinion.
Okay, look at this direct juxtaposition. A qualified opinion means misstatements are material but not pervasive. An adverse opinion, on the other hand, means the auditor obtained sufficient evidence and concluded that misstatements are both material and pervasive. Just adding that one word, pervasive, drastically changes the auditor's verdict. It means the financial statements considered as a whole do not conform with accounting principles and are fundamentally unreliable. It's a massive, glaring red flag.
To really understand how severe this is, let's look at some stark, real-world examples that would trigger an adverse opinion. Imagine a company preparing its financial statements on a going concern basis, which, signals to investors that the business will continue operating normally, even though management secretly plans to cease operations within the next 6 months. That misrepresents the entire reality of the business. It is incredibly pervasive. Another example would be a massive, completely inadequate provision for doubtful debts that totally skews the profitability and balance sheet of the company. In these catastrophic cases, you're going to see the heading, Basis for Adverse Opinion. And finally, Section 6, the disclaimer of opinion. Now, a disclaimer of opinion isn't the auditor saying the numbers are definitely wrong. It's the auditor saying they have absolutely no idea if they're right or wrong, and they flat out refuse to guess. This happens when the auditor is entirely unable to obtain sufficient appropriate audit evidence, and they conclude that the possible effects of those undetected misstatements could be both material and pervasive. The auditor is essentially flying blind here. Because they can't see the true picture, they formally disclaim or refuse to provide an opinion, which forces a basis for disclaimer paragraph into the report. So how exactly does an auditor end up flying blind in the modern corporate world? Well, here are some extreme scenarios. Imagine the auditor is prevented by management from observing the inventory count, and they're also prevented from performing external confirmations of the company's debtors, creditors, and even their bank balances. They are literally locked out of the core financials. Another crazy scenario is the non-receipt of branch audit reports from a highly significant number of a company's operating branches. When the auditor is prevented from doing their job across multiple, pervasive elements of the whole business, they have to back away entirely and issue a disclaimer. So, armed with this newly decoded spectrum of trust, how are you going to read the next corporate annual report you come across? Are you just going to look at the glossy pictures and the top-line revenue numbers, or will you skip straight to the auditor's report to see if you can actually trust a single number on those pages? You are now empowered to decode this vital corporate language. You know the difference between the gold standard of an unmodified opinion, the localized warning of a qualified opinion, and the screaming red flags of an adverse or disclaimer opinion. Keep this framework in mind, and I promise you, you will forever see corporate financial health in a completely new and much clearer light.
So picture this. You're a detective. You're hired to solve a complex case, but the very people who hired you, they refuse to let you see the crime scene. They won't let you talk to the key witnesses, and they lock all the crucial files away. What do? Well, in the corporate world, this exact scenario plays out for financial detectives, also known as statutory auditors. When an auditor is completely blocked from doing their job, what exactly happens to the multi-million-dollar financial report they were hired to verify?
Welcome to The Explainer. Today we're going to decode one of the absolute most severe red flags in all of corporate finance, the auditor's disclaimer of opinion. We're going to break down exactly what happens when the highly trained professionals tasked with verifying a company's financial health are forced to just throw their hands up, step back, and formally declare that they simply cannot do their jobs. It's a truly fascinating mechanism of corporate accountability.
Okay, let's look at our roadmap. First, we'll quickly establish the baseline with the types of auditor opinions. Second, we'll define what a disclaimer of opinion actually is. Third, we'll look at the specific real-world triggers, and finally, we'll explore the modified opinion matrix. Let's get right into it.
Starting off with Section 1, Types of Auditor Opinions.
You know, the ultimate goal for any audit is to get that unmodified, perfectly clean report. It means the statements exhibit a true and fair view of the business. But when things aren't perfectly transparent, opinions have to be modified. And there's a fundamental difference in why this happens. Sometimes the auditor finds a known error, a literal misstatement, like an incorrect inventory valuation. But in other cases, they face complete unknowns because of an absolute inability to obtain sufficient appropriate audit evidence. It's the profound difference between discovering an actual mistake and being completely prevented from looking for one in the first place.
Which brings us to Section 2, the disclaimer of opinion. According to corporate accounting standards, an auditor shall disclaim an opinion when they are unable to obtain sufficient appropriate audit evidence. But crucially, the auditor must also conclude that the possible effects of these undetected misstatements could be both material, meaning large enough to actually matter to investors, and pervasive. We aren't just talking about a missing receipt for some minor office expense here. This means the missing information is so incredibly significant that its absence distorts the entire reality of the company's financial health.
Now, the standard also highlights a really critical caveat. A disclaimer is required in extremely rare circumstances involving multiple uncertainties where it is not possible to form an opinion on the financial statements due to the potential interaction of the uncertainties and their possible cumulative effect. I mean, just think about the severity of that language for a second. Even if the auditor manages to get a little bit of evidence regarding individual uncertainties, the sheer volume of interacting unknowns makes it utterly impossible to guarantee anything. The cumulative effect literally breaks the mathematical and logical process of the audit.
Let's move on to Section 3, triggers for a disclaimer.
So what does this look like in practice? The audit guidelines outline some very tangible situations where management essentially acts as a brick wall, making the financial detective's job impossible. First up, imagine if management actively prevents the auditor from observing the counting of physical inventory. If you can't see the warehouse stock, how do you know the company actually has the assets they claim? Second, imagine the auditor is blocked from requesting external confirmations of debtors, creditors, and bank balances. That is exactly like a detective being told they aren't allowed to call the bank to verify a suspect's alibi. And third, the non-receipt of branch audit reports from a significant number of branches. If a massive chunk of a company's geographical operations goes completely unaudited, the auditor is operating entirely in the dark.
Finally, let's wrap up with Section 4, the modified opinion matrix.
To take the subjectivity out of these situations, auditors rely on a specific variable, and this brilliantly illustrates the core of that concept, pervasiveness. For a lack of evidence to actually trigger a disclaimer, it must be pervasive. This means the effects are not just confined to one specific account. Or, even if they are confined to one account, they represent a massive, substantial proportion of the overall financial statements. Ultimately, a pervasive issue is one that is fundamental to the user's understanding. It's a financial blind spot that infects the entire ecosystem of the company's reporting. Now, this decision matrix from the SA 705 auditing standard weighs two distinct factors: the nature of the issue versus its pervasiveness. If an auditor cannot obtain evidence, but the impact is material without being pervasive, they issue a qualified opinion. However, when that inability to get evidence is both material and pervasive, boom, that is where we hit the disclaimer of opinion. It is the exact intersection of absolute unknowns and massive systemic impact. So, the absolutely crucial point here is this: statutory auditors cannot simply walk away in silence. If an auditor is forced into issuing a disclaimer, the audit report absolutely must include a specific section titled "The Basis for Disclaimer." This is where the auditor formally and publicly documents exactly how they were blocked, what specific evidence was withheld by management, and why it makes the financial statements entirely unreliable. This is basically the auditor loudly ringing the alarm bell for investors, stakeholders, and regulators.
Understanding this mechanism completely changes how you look at these seemingly dry corporate documents, doesn't it? It's not just about numbers, it's about transparency and the strict limits of verification. Next time you read a corporate audit report, will you know exactly where to look to see if the auditor was kept in the dark? Look for that basis for disclaimer. It's the ultimate sign that the financial detectives were blocked from doing their jobs.
So today, we're diving into the fascinating and sometimes slightly messy world of auditing. And look, we're not talking about those easy days where the numbers just magically add up perfectly. Nope, we're getting into the nitty-gritty of how auditors actually report when a company's financial records are, well, not quite right. Specifically, we're unpacking the standards laid out in SA 705.
Because think about it, it is rarely a black and white situation, right? It's almost never a case where a company is completely fraudulent or absolutely flawless. So what happens when financial statements are mostly true, but there's, a significant hiccup? How exactly does an auditor communicate that to shareholders without sparking total panic, while still doing their job and reporting the facts?
Here's our roadmap for this explainer. 1. The audit opinion modified. 2. Meet illustration 1. 3. The misstated inventory problem. 4. The auditor's checklist. And 5. The final verdict. Let's get into it.
Section 1. The audit opinion modified.
Okay, let's dive right into this matrix. This is how an auditor decides what flavor of modified opinion they actually need to issue. If you look at the top row, when financial statements are misstated, the auditor really has to judge two main things. First, is the issue material? Like, is it a big enough deal to matter? And second, is it pervasive? Meaning, does this error infect the entire financial statement, or is it pretty well contained? As you can see here, if an error is material but not pervasive, the auditor issues a qualified opinion. But if it's both material and pervasive, bam, that becomes an adverse opinion. For today's explainer, we're going to be living right in that middle box, the qualified opinion.
Section 2. Meet illustration 1. So the appendix of SA 705 actually gives us this really handy menu of 5 specific illustrations to guide auditors. They range all the way from illustration 1, which is a qualified opinion due to a material misstatement, down to illustration 5, which is a complete disclaimer of opinion because the auditor basically couldn't find evidence from multiple elements. Today, we're laser-focused on that very first one on the list, illustration 1. It's your classic case of a material misstatement that warrants a qualified opinion. Section 3. The misstated inventory problem. All right, so what went wrong? In our specific scenario, the company's inventories are misstated. Now, the best way to think about this is like reading a restaurant review. A material but not pervasive error is kind of like going to a really great restaurant, but your specific appetizer came out totally burnt. It's a real problem, it's material, but it doesn't mean the whole restaurant is a disaster, right? You'd probably write a qualified review. Great place, except for the appetizers. On the flip side, if the kitchen is completely infested and literally every dish is ruined, well, that's material and pervasive. That gets an adverse review. In illustration 1, our inventory error is just the burnt appetizer. It's material, for sure, but it is not pervasive to the company's entire financial standing. And this brilliantly illustrates the exact rules of engagement our auditor is dealing with. So who is this hypothetical company? Under the standard, we're assuming the audit of a complete set of financial statements for a listed company operating under the Companies Act of 2013. They use a general purpose framework, specifically under Section 133, and this is a really important detail. The people responsible for overseeing the financial statements are completely different from the folks who actually prepared them.
Section 4. The auditor's checklist.
Now, before our auditor can just go ahead and slap a qualified opinion on the report, they've got to clear a few pretty rigorous hurdles. First up, SA 210. Management has properly acknowledged their responsibilities. Done. Second, all the ethical requirements of the ICAI Code of Ethics and the Companies Act. Met. Third, SA 570. The auditor has confirmed there's no massive, looming threat that the company is going bankrupt tomorrow. They're absolutely a solid going concern. And lastly, SA 701. The key audit matters have been properly communicated. All these boxes are checked, so the literally only remaining issue is that pesky, misstated inventory we talked about.
Section 5. The final verdict.
So the crucial point is how this all comes together on paper. This right here is the exact wording the auditor is going to use in their report. Listen to how carefully crafted this language is. In our opinion, except for the effects of the matter described in the basis for qualified opinion section of our report, the aforesaid financial statements give a true and fair view. I mean, those two words, except for, are doing some serious heavy lifting here. They protect the auditor, they clearly flag the inventory issue for the shareholders, but they still validate the rest of the company's hard work. It's honestly a masterpiece of professional precision. So, illustration 1 handles the contained error perfectly. It tells us exactly what to do when we know something is wrong, and we can clearly quantify it. But I want to leave you with this provocative thought. What happens when the auditor can't even find the evidence to prove if an error exists or not? I mean, how does the reporting change then? Well, you'll just have to dive into illustrations 3, 4, and 5 of the SA 705 appendix to find out. So, when you think of an independent auditor's report, you probably just think of a simple pass or fail grade for a company's financials, right? Well, actually, there's this fascinating, hidden layer of communication sitting right in the middle of these reports. It allows auditors to speak directly to you about things that really matter without changing that main grade. I want you to imagine, for a second, that you're an auditor.
You've gone through all the books, and technically speaking, the financial statements are totally correct. They follow all the rules. But you've stumbled on a piece of information that is so absolutely crucial. If investors miss it, they're going to completely misunderstand the company's actual situation. So what do? How do you raise a red flag or draw attention to this massive detail without actually changing your core clean audit opinion? That's the exact dilemma we're unraveling today. Okay, let's dive into this. Here is our roadmap. First, we'll look at the auditor's dilemma. Next up, the spotlight, which is the emphasis of matter paragraph. Then we'll cover the megaphone, also known as the other matter paragraph. And finally, we'll wrap up with the golden constraints. Starting right off with Section 1, the auditor's dilemma. Basically, how to raise a flag without failing the company. So the foundation for our entire discussion today boils down to one specific regulatory standard, and that is SA 706 revised. This is the official standard governing the use of emphasis of matter paragraphs and other matter paragraphs in the independent auditor's report. Essentially, it gives auditors a structured, perfectly legal way to add clear, additional communication to their report, but only after they have already formed their main opinion on the financial statements. And this setup brilliantly illustrates the core difference between these two types of paragraphs. You can think of the emphasis of matter like a giant spotlight. It highlights things that are already inside the financial statements. Information the company has already provided, but the auditor wants to make absolutely sure you don't miss it. On the flip side, the other matter paragraph is more like a megaphone. It broadcasts things outside the financial statements, meaning information about the audit process itself that the users really need to know. All right, let's move to Section 2, the spotlight or the emphasis of matter paragraph, and see exactly how it illuminates what's already there. By official definition under SA 706, an emphasis of matter paragraph draws users' attention to a matter appropriately presented or disclosed in the financial statements that is of such importance, it's literally fundamental to the user's understanding. The absolute key takeaway here, the auditor can only use this spotlight for information the company has already properly disclosed. They are not dropping brand new financial numbers on you. They're just pointing a massive neon arrow at existing critical disclosures. Now, because this is such a powerful tool, SA 706 actually dictates a very strict checklist for using it. First off, the auditor has to put it in a separate section with a specific heading, Emphasis of Matter. Second, the paragraph has to make a crystal clear reference to the matter being emphasized and specifically state exactly where the full disclosures can be found inside the financials. And third, and guys, this is vital, the auditor must explicitly state that their overall audit opinion is not modified because of this matter. It's basically them saying, hey, look closely at this, but my overall passing grade for the company still stands. So, what kind of things actually warrant this spotlight? Well, the standard gives us some pretty great real-world examples. It could be a major uncertainty about the future outcome of some exceptional litigation or regulatory action. Or maybe a huge subsequent event that happened after the balance sheet date but before the auditor signed off. It could even be the early application of a brand new accounting standard that materially shifts the numbers. Or, get this, a major catastrophe that has or continues to have a massive effect on the company's financial position. We're talking huge, fundamental issues that investors absolutely need to read about in the notes. Which brings us nicely to Section 3, the megaphone, or the other matter paragraph. This is where auditors get to broadcast the audit process itself. Now, the definition shifts gears here. If an auditor considers it necessary to communicate a matter other than those presented or disclosed in the financials, they pull out the other matter paragraph. This one is strictly for matters that, in the auditor's own judgment, are totally relevant to the user's understanding of the audit itself, the auditor's responsibilities, or the auditor's report. So, bottom line, it's the auditor talking about the audit, not the company's financial data. And just like the spotlight, the megaphone has its own structural rules. When an auditor includes an other matter paragraph, they have to put it within a separate section with the heading Other Matter, or another appropriate heading. This is just to guarantee there's a clear visual distinction in the report, keeping comments about the audit process totally separate from the core financial opinion. So, when exactly would they need to use this megaphone? The standard actually outlines specific circumstances. An auditor uses it when a matter is highly relevant to your understanding of the audit or the auditor's responsibilities. They'll also use it while reporting on more than one set of financial statements at the same time. Or, another big one, when there is a strict restriction on the distribution or use of the auditor's report, meaning the report is legally only meant for a very specific group of people and definitely not the general public.
All right, that brings us to the final and honestly perhaps the most important part of this whole explainer. Section 4, the golden constraints, when these paragraphs simply cannot be used. You see, as useful as the spotlight and the megaphone are, there are incredibly strict boundaries here. Both the emphasis of matter and the other matter paragraphs share a very specific limitation tied to another standard, SA 701. The rule states that you can only use these paragraphs if the matter has not been determined to be a key audit matter. Key audit matters are basically the most significant issues dealt with during the audit of a listed entity. If an issue qualifies as a key audit matter under SA 701, it absolutely has to be reported there. You can't just bypass that and substitute it with an emphasis of matter or other matter paragraph. No shortcuts allowed.
But here is the ultimate rule, and this one is specifically for the emphasis of matter paragraph. It cannot be used if the auditor is required to modify their opinion in accordance with SA 705, revised, as a direct result of that specific matter. So what does that actually mean in plain English? It means you absolutely cannot use a spotlight paragraph to hide a failed audit. If the financials are materially misstated, the auditor must issue a modified opinion. You can't just slap a clean, passing grade on the report and then try to secretly explain away massive errors in an emphasis of matter paragraph.
If you look at this visual breakdown, it shows exactly how SA 705 works in practice. If financial statements are misstated, or if the auditors simply couldn't get enough solid evidence, they're forced to modify their opinion. That results in a qualified opinion, an adverse opinion, or a disclaimer of opinion, depending on just how pervasive the issue is. And if any of those apply to the matter at hand, those modified opinions completely override SA 706. The auditor's core opinion must reflect the underlying problem first and foremost, period.
So we've seen how auditors navigate this incredibly delicate balance of communication, using the spotlight and the megaphone, all while staying firmly within some very strict regulatory constraints. Next time you're reading through an independent auditor's report, don't just jump straight to the final opinion. Keep an eagle eye out for those separate sections. What fundamental disclosures are they spotlighting? What hidden stories will the emphasis of matter or other matter paragraphs reveal about the company or the audit itself? It really is like a giant puzzle.
Today, we're taking what might look like a super dense, dry compliance document and turning it into a genuine financial detective story. We're going to dive deep into the world of statutory audits to see how just one seemingly small decision on a spreadsheet can literally rewrite a company's entire financial reality. It's a fascinating process, so let's get right into it.
So think about it. What actually happens when an auditor catches a mistake? It's the ultimate question, right? When management proudly presents their shiny year-end numbers, but the independent auditor steps in and says, wait a minute, these numbers don't really add up? What are the actual stakes there? And how does that confrontation play out on paper for the whole world to see? Okay, let's dive into this. Here is our roadmap for breaking down the ABC Company Limited document. 1. The qualified opinion explained. 2. Unpacking the inventory error. 3. The financial domino effect. 4. Key audit matters. And 5. Branch auditors and others. All right, kicking things off with Section 1, the qualified opinion explained. You're going to hear the term qualified opinion a lot. Now, outside of finance, being qualified is usually a really good thing, like you're highly skilled. But in the auditing world, it's kind of the exact opposite. A qualified opinion acts as a giant warning label. It essentially means the auditor is saying the financial records are generally fair except for a specific isolated issue. The misstatement is material, meaning it's absolutely big enough to matter to investors, but it's not pervasive, so it hasn't completely corrupted every single aspect of the financial statements. If you look at where a qualified opinion sits on the spectrum of auditor modifications, it's right there in the middle. The financial statements are definitely misstated, which is why the auditor issues this qualification. It's a really serious mark against the company, but it's not severe enough to be an adverse opinion, which would mean the entire document is misleading. Think of it like a contained fire. It's controlled, but hey, it's still a fire. Now, what's really interesting about this slide is that we get to look at the actual real-world document format we're dissecting today. Under A qualified opinion, the auditor specifically states, in our opinion, except for the effects of the matter described in the basis for qualified opinion section, the aforesaid financial statements give a true and fair view. I want you to focus on those two words, except for. They are doing a massive amount of heavy lifting here. Moving right along to Section 2, unpacking the inventory error. Let's zoom into the crime scene itself, the specific section titled Basis for Qualified Opinion, to figure out exactly what went wrong.
Here's the crux of the issue. Translated from the accounting jargon, the company's management valued their inventory in the balance sheet solely at its cost. So they just recorded the inventory at whatever they paid to make or buy it. The problem? The prescribed accounting standard, specifically Indian Accounting Standard 2, demands that inventory be valued at the lower of its cost or its net realizable value, or NRV. NRV is basically just what they could actually sell it for today. Management completely ignored the fact that the actual market value of their goods had dropped. And we need to be really clear here. This isn't just some mild difference of opinion. The auditor explicitly states this is a direct departure from the accounting standards prescribed under Section 133 of the Companies Act 2013. Management broke the rules to artificially prop up the value of their unsold stock.
If you look at the text, the exact monetary impact of this rule breaking is represented by a placeholder variable XXX. The auditor states an amount of XXX would have been required to write the inventories down to their net realizable value. Now, obviously, the exact figure is hidden behind these X's in our illustrative template, but make no mistake, in a real audit report, that number is printed in plain sight. And the impact of that missing number? It's absolutely massive.
Which brings us perfectly to Section 3, the financial domino effect. And this brilliantly illustrates how interconnected the whole financial ecosystem is. Because management refused to fix their numbers, the auditor lays out the hypothetical reality of what should have happened. Step 1, if inventory is correctly written down to its true lower value, that lost value doesn't just magically vanish. Step 2, it's immediately recognized as an expense, meaning the cost of sales goes up. And step 3, because expenses just spiked, the company's overall net income goes down. It's a total chain reaction. Let's summarize the full impact of this. Because those unsold boxes in the warehouse were overvalued, a proper correction means inventory is reduced and cost of sales is increased. And since profit is now lower, income tax is reduced. Ultimately, net income and shareholders' funds take a direct hit by that exact XXX amount. So, by refusing to write down bad inventory, ABC Companies management was artificially inflating their profit and making shareholder value look way healthier than it actually was in reality. Let's zoom back out to the macro level for Section 4, Key Audit Matters. Now, beyond that glaring inventory error, auditors also have to communicate what are called Key Audit Matters, or KAMs. Governed by Standard on Auditing 701, these are the matters that, in the auditor's professional judgment, were of most significance during the current period's audit. This gives investors transparency into the really challenging parts of the audit. Importantly, they are addressed in the context of the audit as a whole, and the auditor does not provide a separate opinion on them. They're essentially saying, hey, aside from that qualified error we just talked about, here's what else kept us up at night during this audit.
And finally, Section 5, Branch Auditors and Others.
So large entities like ABC Company Limited rarely operate out of just one single building. They have branches all over the place. Because of this, it is totally standard practice for the main principal auditor to rely on the groundwork of local branch auditors to piece the whole financial picture together. Section F of the report clearly discloses the exact amount of assets and revenues that were audited by these separate local branch auditors. But check out the crucial phrasing here. The auditor explicitly concludes this section by stating, "Our opinion is not modified in respect of this matter." This is a really important distinction. Relying on branch auditors is totally normal. It doesn't trigger a red flag, and it definitely does not cast doubt on the financial statements. The only reason this particular report carries a qualified opinion is because of that stubborn inventory issue we looked at earlier. So what does this all mean for us? Well, we've just seen firsthand how a single, seemingly obscure accounting choice, like failing to mark down inventory to its net realizable value, can artificially inflate a company's entire reported profitability. It really makes you wonder, right? If one hidden calculation in the except for basis for qualified opinion can completely topple a company's net income, what else is hiding in the dense, structured footnotes of the companies you invest in? Understanding these documents isn't just about ticking compliance boxes. It's about seeing the true reality of a business. Thanks so much for joining me on this explainer, and definitely keep your eyes peeled for those except for clauses.